Welcome to the first episode of The Logic of Money. I'm your host, and today we are stripping away the emotion and the hype to look at a devastating reality in the U.S. Sunbelt. For years, cities in Texas and Florida were sold as the ultimate recession-proof passive income machines. But as of March 2026, the math has violently broken. Joining me today is Mr. Croft, our senior researcher here at DoughLogic. Mr. Croft, we just saw Dallas-based Lurin Capital file for Chapter 11 bankruptcy protection. Basis your research, can you please give us the scale of this failure?
The scale is historic for the multifamily sector. Lurin Capital wasn't a mom-and-pop operation. At their peak, they managed 10,000 apartment units across 19 different markets. But as of the court filings on March 3, 2026, they have defaulted on at least $710 million in loans. These properties are primarily in Texas and Florida, and many have already entered receivership.
$710 million in defaults. The part that confuses retail investors is the pedigree behind this. Lurin was led by John Venados. This is a former hedge fund manager with a background at Citadel and Merrill Lynch. He brought literal Wall Street credentials to the apartment syndication space. How does a Citadel veteran fail at basic risk management?
He failed because he prioritized aggressive scaling over margin of safety. Venados built Lurin's empire on a highly fragile foundation, floating rate debt. In 2021, when they were aggressively acquiring properties, debt was practically free, but they didn't lock in those low rates long term. They relied on short-term interest rate caps. When those caps began expiring in the summers of 2023 and 2024, the Federal Reserve was in the middle of a massive rate hike cycle.
So when the caps expired, they were fully exposed to the market?
Exactly. According to the data, their interest payments effectively tripled. An apartment complex that was printing cash in 2021 was suddenly bleeding millions by late 2025.
Okay, so the macroeconomic bet failed. That happens in investing, but the court dockets that DoughLogic pulled show that this wasn't just a failure of interest rates. There are serious allegations of misconduct here, right?
Yes, many reporters reported extensively on the lawsuits piling up against Lurin. Lenders are alleging systemic fraud. The lawsuits claim that Venados falsified documents and explicitly diverted funds to personal accounts.
Diverted funds? You mean the money that people working hard to earn each day, our teachers, doctors, engineers, invested into these syndications?
Yes, and the money meant to maintain the buildings. The lawsuits allege that Lurin inflated repair invoices by using affiliated contractors to drain early access to lender funds. And the human cost here is staggering. Because the money was allegedly diverted, the properties fell into severe neglect. Regulators and tenants reported uninhabitable conditions. In some cases, cities had to intervene and force evacuations due to major code violations. They weren't paying utility bills.
That is the dark side of passive income. The gurus sell you the dream of a 15% return, but if you don't have auditing power over the general partner, you have no idea if your capital is fixing a roof or padding a personal account.
It gets worse. Internal employees at Lurin reported missing 401k contributions before the collapse. When a financial firm stops funding its own employees' retirement accounts, the liquidity crisis is absolute.
Let's bring this back to our audience. The people watching DoughLogic right now might be holding 5% of their portfolio in a mutual fund SIP, or maybe they're holding infrastructure stocks that took a 20% hit recently. Market drawdowns are normal, but a total wipeout of capital is different. How did retail investors get trapped in Lurin?
Syndicators use the illusion of institutional safety to lower the retail investor's guard. They see a former Merrill Lynch guy, they see a glossy pitch deck, and they stop doing the math. In Lurin's case, the investors were hit with capital calls before the bankruptcy.
Explain a capital call for those who haven't experienced one.
It's an ultimatum. The syndicator emails the investors and says, the bank is about to foreclose. If you don't wire us another $25,000 by Friday, your original $100,000 investment will be wiped out completely. It's financial hostage-taking. And the tragedy is, even for those who paid the capital calls to Lurin, the bankruptcy filing on March 3rd means the equity is likely gone anyway.
So, Soren, looking forward, is Lurin Capital an isolated incident, or is this the canary in the coal mine for the U.S. real estate market?
It is just the beginning. The Mortgage Bankers Association recently reported that $875 billion in commercial property debt comes due this year alone. That is a massive maturity wall. Lurin, along with other distressed firms like Tides Equities and GVA, proved that the floating rate strategy was a systemic error across the entire Sunbelt.
So, what is the logical takeaway for our listener today?
Never invest in a capital structure you cannot map out on a single piece of paper. If an investment relies on perfectly timed interest rate caps, aggressive rent inflation, and zero macroeconomic shocks, it is not an investment. It is a highly leveraged speculation. Respect the math of debt, because debt does not care about your pitch deck.
Mr. Croft, thank you. Subscribe and stay tuned for more content research-driven insights.